Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week, and therefore what a show. Have we got an agenda for you at the top? And I'm telling you, for all my NFL draft fans, you'll be glad to hear this. We're going to start with a Wall Street Journal article by Mr. Andrew Beaton about the NFL draft prospect moonlighting as an investor. That's right. The NFL draft, as you're listening to this, will be entering day 2, with day 1 of the first round occurring Thursday evening, second round Friday evening. We're going to talk NFL draft and this great article about Mr. Braden Fisk, nose tackle for Florida State, what he's doing with his money. We then are going to get into a wealthmanagement.com article that I believe was distributed by Bloomberg, but I can't be sure, about some new stock exchange traded funds offering 100% downside protection. These are new products coming out. We must talk about them because, goodness gracious, I think it's going to sell like hotcakes, unfortunately. And then we get to step into Robert's Corner. The producers really were pushing me this week to consider having Robert's Corner. I said, okay, all right, let's do it. And for the corner this week, we are going to be looking at the large custodians and the pitfalls that can occur in them, meaning Vanguard, Charles Schwab, Fidelity. In the corner this week, I'm going to give you some experiential knowledge that I hope to pass on to you about what can happen. Because boy, howdy, are they changing the rules of the game halfway through it over there. But let's start NFL draft. If you want to simulate the NFL primetime music right now in the background to help kind of engender some enthusiasm for this. Dun, 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 dun. That's right, Mr. Braden Fisk. He's in his 6th year of college football. I thought this article was important for us because whether Mr. Andrew Beaton, the journalist, intended to or not, this is a perfect walkthrough of how someone learns how to invest. So first, a little background. This Mr. Fisk was making good NIL money. So as you guys know, being a college athlete, it's good NIL money. And that means a lot of these folks are going to need to invest. Mr. Fisk was at Western Michigan. He then entered the transfer portal and really did a great job. So he did a great job at the combine. He is an older player, but 6'4", 292. They're thinking he's going to go in the first couple of rounds, so that's a big payday. And Mr. Fisk has started to learn how to invest. So what I liked about this article is it outlined just how Braden started, and what he started with was education. So what the article talks about is, one, he recognized the limitations, and he had a little fear. So what Fisk talks about is how he had seen a lot of folks make mistakes with money. And this is his quote. He said, "I had seen and heard enough horror stories of guys spending all their NIL money," that's that name, image, and likeness money, "and forgetting that taxes exist," he says. He admits he had no idea what he was doing when he began investing at a young age. His uncle had a job as a stockbroker. But just let's follow this. So he sees a problem. He recognizes that, oh, wow, I'm probably no better than my peers. I need help. He then, what he doesn't do is abdicate. This is where a lot of folks mess it up. And Magic Johnson is the one I'll point to most frequently about someone who really did a great job taking ownership and learning. But this guy, he said, I'm going to start reading books. And it talks about the book. One of the books he read was Rich Dad, Poor Dad by Robert Kiyosaki, which is a pretty good book. And he just kept learning and kept learning and kept learning. Notice the difference here, Mr. Braden Fisk, the different path he's taken, the road less traveled, the narrow road, if you will, versus what the vast majority of athletes will take, which is abdicate, use relationships as best as you're able and use trust and hope that the results are okay because you don't know what you're doing. Mr. Fisk is taking the harder road, but the better road. He's saying, I'm going to read. I'm going to not let my consumption muscle be flexed. He says it was tough to go back past Mercedes-Benz dealerships when he had all this money. He's invested $100,000. That's all his NL money, I guess, maybe after taxes, what he's got in the account. And it talks about how when he first started out, he was checking the account all the time. He wasn't listening to the RHF market update. He was checking that app all the time, every day, and realizing, checking the app doesn't really do a lot. Good lesson. He's got to keep that time horizon long. And this is one of my favorite parts of the article. The article explains one of his most successful picks has been the Fidelity 500 Index Fund, which is up 21% over the last year. When he does buy shares, it says he does these DRIPs, which I think is totally optional, dividend reinvestment plans, yada, yada, yada. But let's learn from Mr. Fisk by following what he's doing right. One, admitting he doesn't know what he's doing. That's the first stage of learning. That's the second stage. The first stage is you don't know that you don't know. The second stage of learning is you know that you don't know. What a good place to be. The third stage of learning is you know that you know. The fourth stage is you don't know that you know. That's that master level. You're reactive. You don't even think about it. But to admit our ignorance, to realize we don't know what we're doing, incredible benefits there. And then what did he do first? Education. Recognizing limitations, not falling prey to the consumption muscle and feeling like he has to advertise to his peers how well he is doing. No, he's investing in his future. That is a really good way to start. And I want to take this time to also reference Mr. Herm Edwards, who typically, Herm Edwards being a former coach of the New York Jets, Kansas City Chiefs, Arizona State Sun Devils, and ESPN personality, great communicator. He was brought in for the rookies in the NFL to give them a kind of a pep talk on life, but it focused on money. And I just wanted to add this because simple rules are able to be executed on and stuck with. So you can go too simple, but when in doubt, simple rules. And Coach Herm Edwards, when I watched this video of him talking to the rookies, he said it's the rule of one. Don't forget the rule of one, rookies, okay? What's the rule of one? You get one house, you get one car, you get one wife or girlfriend. That's it. So Coach Edwards is talking about that consumption thing, but just simple rules. Simple rules. Not cost low, investing simple, time horizon long, but again, 3. Coach Edwards just one house, one car, one wife, or girlfriend, hopefully on the track to being a wife, courting. But those rules can protect us in big ways. So if you're watching the draft, I bet you're not. But if you are, we are at my house, because the great Bobby Hunt loves the NFL draft. Let's look out for Mr. Fisk. Let's see what he's doing here. Next up, this is a wealthmanagement.com article. New stock ETFs offering 100% downside protection are coming. The first fund launching within the suite is the Calamos S&P 500 Structured Alt Protection ETF, which aims to match the price return of the Spider S&P 500 Trust up to a cap of 9.65%. Let's explain what's going on here. So there is an ETF that's very well-known, famous, SPY, the Spider S&P 500 ETF, very large, traded quite a bit. What this group is saying is, hey, we are going to have a product that when you buy it, you can't lose money on it. What? How is that even possible? It seems like we figured out how to turn lead into gold or something. But it's got a cap. Now, products like this have been out, but why is this happening? How is this possible? Well, the article explains with risk-free rates north of 5% today. Okay, so that's that when I talk about those money market funds at Vanguard at 5.27% and short-term 0 to 3 month U.S. Treasury bills. it becomes an environment. It says option-based product issuers are able to deliver meaningful upside participation with 100% capital protection, said Matt Kaufman, head of ETFs at Calamos. For those issuing protective products, the cost of hedging by selling an option or series of options to offset the premium to buy a protective put becomes cheaper as rates rise. Well, let's just cut through the gobbledygook and the Egyptian there. Suffice to say, higher interest rates make it easier for these companies to offer these products. Okay, that's all you got to know. So when you ask yourself, well, why didn't these exist, 4 or 5 years ago? Well, they couldn't offer that much upside with promising no downside. Now, no surprise to the audience, I don't like these. I don't like them. Now, do I think this is the worst thing in the world? No, I don't think it's the worst thing in the world. I can anticipate the price. They're not out yet, but I can anticipate the price will be a lot more than simply buying a plain vanilla index fund. What I really don't like is what it kind of admits psychologically, what is kind of happening in the mind of an investor when this happens. So if your risk-free rate is about 5.27 or so, then what this is offering you is about 4.3 or so percent more. That's a 4.3% premium cap. All right. So, wow, is that a trade you want to make? I think some people might say, okay, great. What could be so wrong? But in the long run, you're never going to want to do something like this. You will always underperform with these sorts of products. How so? Well, let's play it out. Let's say the market earns 20% in a year. It can happen. There's a ton of volatility. You're capped. You're 9.65. Let's say the market earns 1%. Well, that didn't do anything for you, did it? Now, if the market goes down, admittedly, you will have a cap there, but there are better ways here. A simple way to think about these products is anytime an intermediary is adding these layers of protections and hedging, and you can cap here and floor here, and there are 20 different ways they can slice this to sell your product. It's not going to be better for you in the long run. They're not doing all that for free. And if you really, really are worried about losing money, I would just buy some bonds and buy some stocks and not go through these intermediaries. But I think this is important to look at because this is going to be tempting for a lot of folks. There's no doubt. And there are going to be resets on these funds. So this is definitely not investing simple, and time horizon is not going to be long, and costs are going to be high. So it's certainly not going to fit the lattice work that we've created here as an RHF community. But I get it. I really do get it. It's kind of the elixir of life. What if we could have investments that only go up and not go down? Well, that'll exist in a risk-free rate environment of 5.3%. These companies can squeeze out a little more, and you get what I'll describe as kind of a marginal return profile. So there are worse things in the world, to be sure, worse things in the world, but no surprise if something like this is offered, you don't need to do it. You don't have to do it. Usually it's a great window in the mind of an investor when they do want to buy this. I can kind of call time out and say, whoa, walk me through how you think about investing. We may not be thinking about it rightly. Okay, the producer's buzzing me here. Yep, I hear you. Okay, it's time for Robert's Corner. It is time for the corner. So come on in. It's a wonderful day in the neighborhood. Won't you be mine? Won't you be mine? Won't you be my fellow investor in the corner? We're going to be talking about the lived experience. That's a popular term in 2024. My lived experience at various custodians and ways in which you perhaps can learn from that and avoid some of the pitfalls. So my practice, as many of you know, is predicated on these various custodians, Charles Schwab, Vanguard, Fidelity, offering portals for self-directed investors. Because what do? I help self-directed investors make great decisions, but on their own, clicking the button, with all these custodians, you can be self-directed, right? A custodian means I give my money to Vanguard, but I'm the one clicking the button. I'm the one deciding where to go. Same deal with Schwab and Fidelity. However, no surprise, all of these platforms, and I've mentioned this in previous episodes, make almost no money on you going in there and buying index funds. Zilch, zero, nada, nothing. Schwab has a cash program that makes a little money where they pay you kind of close to 0% on cash that isn't given a job, which you got to work around for sure. Fidelity's got a little bit like that. Vanguard doesn't. But I want to just give you a heads up. So let's take Vanguard, okay? Beloved Vanguard. I like them for a lot of reasons still, and yet my experience of the previous couple weeks has seen an increase in the cross-selling programs they have. So Mr. John Bogle, our great North Star, founder of the Vanguard Group, inspiration in many respects for the philosophy of investment at this podcast and my practice, he would roll over in his grave. They are offering private equity. Vanguard is pitching private equity to existing Vanguard customers who use or don't use some of the Vanguard advice platform, which I actually like. So there have been I want to speak positive here. There have been instances where I've, for whatever reason, someone can't click the button themselves, or maybe maybe they're older, they don't have relational capital to get help. I actually like Vanguard's advisor services. I do. It costs about 0.30% or so, which as far as advisors go, is pretty good. Typically, I've seen their solutions be pretty fair. They probably use more ETFs and index funds than I would, but it's not that bad. This is the road they're starting to go down, so just be careful. They're pitching private equity funds to you that are high-priced and complex and have lockups and all that. So you just got to watch your back a little more at Vanguard than you did before. Still a good platform. We can use these platforms. Schwab. Okay, what is Schwab doing right now? Schwab is pitching these intelligent portfolios, and they're also trying to get you to do direct indexing. Schwab is truly a pitch marketplace. Great platform, but you've got to be wise as a serpent, innocent as a dove when you walk into Schwab. Be very clear and direct with whoever your advisor rep is. I mean, the more you keep it Schwab, the more calls you will get. But telling them, hey, I'm on my own. Thank you so much. But these Schwab intelligent portfolios, what they do is it's like a robot. Here's your 20 different ETFs, and we've got all this back-tested data. Well, when you go and look at the ETFs they choose for you, they're not choosing the cheap ones, guys. Wouldn't you know it? The robots think that high prices are good for you. Is it the robots, guys? This is something I'm going to be watching, and you should too. The AI revolution, I think, is going to be comical at times in the investing advice space, because my suspicion is you can kind of control what the robots think, and I think a lot of people are going to program them to, surprise, pitch you higher price products. So in the in the Schwab Intelligent Advisors little deal, just if you hire them to do that, they're going to go high priced. And in Fidelity, I talked about it recently, they're trying to push out you being able to use other products that aren't paying them fees. So it's not a neutral platform. None of these are anymore, by the way. You've got to have a guide at times to walk you through them. I do that. Got to have that. Got to be ready for that. But you can do it. So using these platforms is good. It's incredible financial infrastructure. We have a lot to be thankful for. You've got to be willing to tap dance where you need to with a smile on your face. Tell them no thanks, because you're focused on what you know to be true, which is keeping those costs low, keeping that investing simple, keeping that time horizon long, because that's what's going to give you the best shot on your investing journey.